Hi, and welcome to the Early Retirement Roadmap Podcast, the show where I help you prepare for and design a life you love after work. At 55, I retired early, and I created this channel to share the unvarnished truths about achieving and living in early retirement, straight from someone living it. Most advice you see comes from financial planners, but what about the lessons you only learn by doing? Like how a safe index fund once cost me $17,000 in taxes. Before we dive in, let me be clear that what I'm sharing today is based on my personal experience and research. And while I'm excited to share these insights with you, this is for educational purposes only. Remember, everyone's situation is unique, so be sure to consult with qualified financial tax and legal professionals before making any investment or retirement decisions. So, yeah, it's true. I had to pay $17K in taxes one year. And man, was that hard to swallow when I had to pay that all into the government, especially as it was so unexpected. It's because of a sneaky trap hiding in a fund I was investing in that I thought was safe, and it had been until this tax surprise sprung up on me. And I had no idea it was lurking there. If you hold mutual funds, even index mutual funds, in a taxable account, you need to hear this. And it's something that, quite frankly, you don't hear a lot about. And I certainly didn't know about it, which is why it caught me by surprise. Now, when I first started investing, I listened to many experts, and what I always heard was to invest in index funds that follow an index because they historically outperform actively managed funds. So that's exactly what I did. I did that in my 401k, my IRA, my Roth, and I also opened up a taxable brokerage account with E-Trade that I used to dump money in when I maxed out the money I could put in the other accounts for any given year. And I found mutual funds that I really liked, and they performed really well for me. There was one index mutual fund in particular that I really liked that followed the NASDAQ index. With my investing, I pretty much had it all on autopilot. I picked some good index funds and then I just put away as much as I could that my wife and I didn't need to cover our expenses. And eventually that grew enough so that I could retire early, which I did so last year at the age of 55. However, one year as I was doing my taxes, I got a huge tax surprise. I owed $17K in taxes. Of course, I was shocked and had to figure out what happened, and it was this. And it was something I was completely unaware of and hadn't heard. Mutual funds, even passive index funds in a taxable account, will force taxable distributions on you when they rebalance. The reason why fund managers rebalance mutual funds is to keep the investment mix in line with the fund's goals. Let me explain using a gardening analogy. Imagine you have a garden bed where you plant equal amounts of tomatoes and basil because they complement each other. Over time, the tomatoes grow fast and start taking over, shading out the basil. And if you let that continue, the basil really starts struggling and your garden won't have the balance you really need it to have. So, to keep things in check, you cut back some of those tomato plants to encourage the basil to grow and get more sunlight. So, this way, your garden stays balanced and both plants thrive. In the same way, with an index mutual fund that tracks the NASDAQ index, the fund managers will do the same. Since the fund is supposed to track the index, it should hold the same stocks in the same proportions as the index. If there are some stocks in the mutual fund that shrink in value, they might become too small in the portfolio compared to their weight in the NASDAQ index. So, to rebalance, the fund managers buy or sell stocks to make sure the fund continues to match the index. For the fund I was invested in, they did this once a year in December. So rebalancing is a good thing. And when in a non taxable account, like an IRA or 401k, where you're not taxed until you withdraw the money, or a Roth IRA where you're never taxed, it's fine because they are selling stocks out of the fund to rebalance. And those sales don't impact you because you're not taxed on the gains of those funds. However, that's different when you have the same fund in a taxable brokerage account. When the fund managers rebalance those funds, you're going to get taxed on the gains and pay long term capital gains tax on stocks in those funds you've held over a year, which are taxed at lower rates, and short term capital gains tax for stocks you've held less than a year, which, yikes, are taxed at ordinary income rates. And the worst part is you have no control over what the fund managers do when they rebalance. You just get hit with the distribution and getting a surprise tax bill you were not expecting. It's like getting a bill for a party you didn't attend. So when this happened to me, I was shocked and surprised, but I was not going to let that ever happen to me again. And it also shows how you shouldn't always go it alone like I did and get a second opinion, ideally from a professional, to avoid these kinds of mistakes. So I definitely learned my lesson there. Thankfully, I was employed when this happened and had health insurance through my employer. But can you imagine the potential impact of your subsidies if you're on an Affordable Care Act plan? When the fund rebalances and distributes gains to you, that's income you're taxed on. So that will increase your modified adjusted gross income that your subsidy is based on. And it could greatly reduce your subsidy or remove them altogether if it pushed your income high enough. Not to mention potentially also pushing you into a higher tax bracket. So here's what I did because that fund I really liked, I was not so happy with being in my taxable brokerage account. And I certainly did not want to get another tax surprise again. So, what saved the day? I swapped out that index mutual fund with an ETF or exchange traded fund that also followed the NASDAQ index, but wouldn't create that surprise tax bill for me when the fund rebalances. Why? It's because ETFs trade like stocks. You are in total control of when you sell them and get gains, and therefore when you pay taxes, which is not the case with an index mutual fund in a taxable brokerage account. Additionally, ETFs rarely distribute capital gains to investors, so they are naturally more tax efficient. With index funds, when they rebalance in particular, they can certainly distribute gains, which in a taxable account creates a taxable event. And no one likes a taxable event, right? I certainly don't. So ETFs are the solution. However, I couldn't just swap out the index fund and replace it with an ETF, as if I did that, if the shares had gained in price that I was selling, I would then pay taxes on those gains. So I had to be strategic about it. And that's where something called tax loss harvesting comes in. Now, it sounds fancy, but it's not. And no, I'm not referring to another gardening analogy. It's just selling losing shares in a fund to offset gains or income. So I sold shares in that index mutual fund at a loss when I could, and this allowed me to swap out those funds into an ETF that also followed the NASDAQ index without paying any additional tax because I didn't have a gain since I sold them at a loss. If I had been in the situation of having an ACA plan, this strategy can also help in keeping ACA subsidies, as lowering your AGI or adjustable gross income is critical to keeping those subsidies in place for health insurance. The other thing I did in the index mutual fund is I stopped the setting to reinvest distributions and had them go to cash instead. That way, instead of reinvesting the money in that same troublesome mutual index fund, I could move that money into the ETF instead that followed the NASDAQ index as well. Now, I have to admit that when I did sell at a loss to take care of this, psychologically it felt like admitting defeat. But as soon as the money sold out of the mutual index fund, which happened after market close, the very next day I put it in the ETF that also followed the NASDAQ index. And it was really in the same funds as the index mutual funds. So I was buying into that at a lower price and getting a much more tax efficient fund at a discount. This move, I really patted myself on the back because it got me out of the potential tax bomb that the index mutual fund was. The loss also offset some of my ordinary income, and the ETF I invested in was better than the index mutual fund because I had a lower expense ratio that I ended up figuring out saved me $520 per year for every 100K I ended up having invested. So this move was a win, 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 and bulletproof my portfolio against those future tax surprises. So there you have it. At all costs, avoid index mutual funds and taxable brokerage accounts. Please learn from my mistake. Go with an indexed ETF instead. This will put you in control and not fund managers deciding your tax bill. That's all for today's episode of Early Retirement Roadmap. If you found this information helpful, please leave a review and subscribe wherever you get your podcasts. And don't forget, you can also find me on YouTube. Just search on Early Retirement Roadmap or find me on the web at mikeupland.com. Until next time, this is Mike Upland, reminding you to take care and make the most of today.